Today, we're breaking down how that breakout could be just getting started. We mapped out a highly strategic, mathematically backed entry zone, and what happened next was nothing short of surgical precision. Over the past few weeks, ASTS didn't just rebound. It completely shattered its bearish structure and left the short sellers scrambling for the exits. So here's what you need to ask yourself. What if the biggest move in this stock hasn't even happened yet? What if everything you saw in July was just the setup for something far bigger? Today, we're deconstructing exactly how this trade played out, the genius dilution shield that the media completely missed, and why a massive multi-million share short squeeze could be sitting right on the horizon. Now, before we dive into the numbers, if you find this kind of deep dive breakdown valuable, do me one quick favor and hit that like button and subscribe. It genuinely helps us keep bringing you this level of analysis. All right, let's get into it. But to understand where this stock is headed next, we first have to look at exactly how we got here. July 19th, the narrative surrounding AST SpaceMobile was exceptionally grim. Wall Street was treating this pre-revenue space technology company like a speculative vaporware project, something that would never actually work. So when the company announced its massive debt raise, the immediate gut reaction from the financial media was that retail shareholders were about to get absolutely crushed by immediate massive equity dilution. But here's the thing. If you actually read the filing, word for word, the reality was the exact opposite of what the headlines were screaming. And we used that blind panic to our advantage. We established a high-conviction buy setup, predicting with near-surgical, market-defying precision exactly where the stock would bottom out and how each catalyst would unfold. If we dig deeper into the actual numbers on the daily chart, the execution of this setup is honestly remarkable. Let's look at the raw price action. We called for an optimal entry zone between $54 and $56.50. And right on cue, on Monday, July 20th, the stock dipped to a daily low of $56.12. Then on Friday, July 24th, it touched $55.73. Those were two flawless, low-risk entry windows sitting right in our target zone. Now, did we see a brief deviation from the plan? Yes, we did. Broader sector panic dragged the stock down to brief capitulation lows of $53.36 on July 28th and $52.80 on July 29th. But watch this closely. The price never once closed below our structural invalidation level of $49.50. The trade setup remained 100% intact the entire time. And then, the rocket ignited. We smashed straight through target 1 at $63.81. We rocketed past target 2 at $66.50, and we slammed right into our final target of $70 on August 4th. Today, the stock is consolidating beautifully around $72.40, transforming what was once heavy psychological resistance into a firm support floor beneath it. Now, you might be wondering, why did the market panic so violently in the first place? And what exactly did we see that everyone else missed? The mainstream media absolutely loves a scary headline. So when AST SpaceMobile priced its massive convertible note offering, the headlines only focused on the gross capital being raised, immediately assuming enormous dilution for shareholders. But they completely ignored the strategic reality underneath. Management knew precisely how the market would react, and they proactively built a literal dilution shield to protect their long-term retail backing. So while the algorithms and the panicking retail traders were dumping their shares, smart institutional money was quietly loading up, because they understood the structural math behind this deal. So what exactly is this dilution shield, and how does it actually protect your investment? Let's break down the mechanics, because this is where it gets fascinating. Yes, AST SpaceMobile raised a massive $1.15 billion in gross proceeds through a convertible senior notes offering, but here is the genius part that nobody reported on. They immediately redirected $96.9 million of those proceeds to purchase what are called capped calls. What does that mean in plain English? It means they bought dilution insurance. This shield mechanism ensures that equity dilution is hard capped all the way up to a stock price of $149.20. That represents a massive 125% premium from where the notes were originally priced. And the total estimated equity dilution from this entire multi-billion-dollar raise, it's kept to under 2%. Let me repeat that. Under 2%. This is one of the most shareholder-friendly capital raises we have ever seen in the entire growth sector. And yet, the market handed us a golden buying opportunity, simply because they couldn't be bothered to take 5 minutes and read the actual SEC filing. And that structural reset has completely reshaped the technical setup on the chart. If we shift over to the technical chart, ASTS is transformed from a speculative, momentum-fueled roller coaster into a highly structured, execution-driven recovery pattern. After hitting an all-time high of $133.86 on May 28th, the stock fell into a textbook falling wedge bullish reversal pattern throughout June and July. And we successfully broke out of that wedge in late July, exactly as anticipated. Even more impressive, the stock has reclaimed and firmly held its 21-day exponential moving average near $65.93. Right now, we are coiling in a tight consolidation between that 21-day support and technical resistance at the 50-day moving average of $72.39 and the 200-day moving average of $75.61. Why does this matter so much? Because retaking these long-term moving averages is the #1 trigger that forces massive, automated buying from professional institutional managers, and that could be the spark for the next leg up. The technicals are only half the story. Let's talk about the absolute powerhouse of fundamental catalysts that occurred just days ago. On August 5th, 2026, AST SpaceMobile took a massive giant leap forward. They successfully launched BlueBird satellites 11, 12, and 13 into orbit aboard a SpaceX Falcon 9 rocket. So let's put that ridiculous vaporware narrative to rest once and for all. These are not speculative models sitting on a drawing board. They are the largest commercial communications arrays ever deployed in low Earth orbit, period. These next-generation arrays are 3 times larger than the previous Block 1 satellites. And in terms of real-world performance, they are capable of delivering peak data rates approaching 200 megabits per second, directly to standard, completely unmodified smartphones. No special hardware, no dish, just your everyday phone. This is no longer a science experiment. This is an active orbiting commercial network, and this technology is about to go live all across the globe. This is a truly global rollout unfolding in real time. In the United Kingdom, AST has officially notified the FCC that commercial direct-to-cell services are set to begin imminently. They're partnering with Vodafone, using Vodafone's licensed spectrum and authorized gateways like Goonhilly Downs. Meanwhile, over in Japan, direct-to-cell operations are also launching imminently through Rakuten Mobile using their 700 MHz spectrum. Rakuten is targeting limited commercial service by late 2026, with full nationwide coverage slated for fiscal 2027. And if that isn't enough to get you excited, active integration testing is already underway across 8 European nations, in collaboration with telecom giants like Vodafone, Deutsche Telekom, Orange, and Telefonica. Just imagine the scale of what's being built here. But while Europe and Asia are getting ready to go live, the regulatory green light just flashed right here in the United States. Just a few days ago, on August 14, 2026, the FCC officially granted ASTS a 30-day special temporary authority to begin testing satellite connectivity across the entire United States. And who is the partner on this? T-Mobile. ASTS will be testing using T-Mobile's incredibly valuable 800 MHz spectrum. Now, if you understand anything about telecommunications, you know that low-band spectrum is absolute gold. Why? Because it provides superior signal range and deep cellular penetration into notorious dead zones and remote geographic valleys, the exact places where your phone normally shows 0 bars. This regulatory milestone is a massive validation of the company's U.S. commercial capabilities, and it clears the runway for future commercial approvals. Now, none of this matters if the company is quietly burning through all its cash. So let's look at the actual numbers behind their most recent earnings report. On August 10th, ASTS reported a second quarter GAAP net loss of 77 cents per share, and predictably, the financial media immediately tried to paint this as a total disaster. But if you look past the headline noise, the cash reality tells an entirely different story. Over half of that GAAP net loss was driven by a single $125.9 million non-cash charge. This was simply an accounting write-off tied to the involuntary conversion from the BlueBird 7 launch incident on Blue Origin's New Glenn rocket back in June. In other words, it's an accounting artifact on paper. It is not an operational cash drain. Meanwhile, the actual underlying business is absolutely exploding. Second quarter revenues surged 2,600% year-over-year, reaching $31.52 million, more than doubling the $14.73 million they posted in the first quarter. That is explosive, exponential growth by any measure. And because of their recent strategic moves, they've now built an absolute fortress of a balance sheet. Following the July raise, AST SpaceMobile is now sitting on a staggering $3.7 billion in pro forma liquidity. Just let that number sink in for a second. For a company at this critical stage of deployment, near-term funding risk has been completely eliminated for the next 2 to 3 years. This immense war chest gives them the complete strategic runway they need to reach their target of 45 to 90 satellites for continuous, uninterrupted global coverage. And the demand side? It's already locked in, with their contracted commercial order backlog swelling to a massive $1.3 billion. With the fundamentals now fully secured, the stage is set for what could be an absolute explosion in the stock price. So let's talk about the highly combustible short squeeze potential, because this is where things get really interesting. As of July 31st, 2026, ASTS carried a massive short position of 56.85 million shares. That represents 18.51% of the entire public float, and it has a days-to-cover ratio of 3.3 days. What does that mean? It means if a major catalyst suddenly hits, it would take over 3 full days of average trading volume for those short sellers to buy back all their shares. And what's driving all this urgency? Well, on August 4th, SpaceX's earnings revealed highly aggressive ambitions to build out their very own mobile network, and that has created absolute panic among legacy carriers like AT&T and Verizon. Think about their position. They have the wireless spectrum. They have millions of loyal customers, but what they do not have is the satellite technology to compete. And this is the key question. Who becomes their ultimate saving grace? AST SpaceMobile. This sets up a perfect storm for a violent, fundamentally driven short squeeze. But the immediate squeeze potential isn't only about the short sellers, it's also heavily stacked in the options market. If we look at the upcoming options expiration, the call options chain is incredibly stacked, creating massive upside gamma exposure. Here's why that's so powerful. Market makers who sold all these call contracts are structurally forced to go out and buy millions of underlying shares of ASTs to hedge their positions as key strike prices get breached. Look at the open interest piling up. There are 4,527 contracts at the $65 strike, 4,838 contracts at the $70 strike, then a massive wall of 8,774 contracts at $75, 11,000 contracts at $80, and an almost unbelievable 25,724 contracts sitting at the $100 strike. So here's the exciting part. If ASTs retakes its 200-day moving average and breaks past $75, this entire options chain could act like a giant gamma magnet, pulling the stock violently upward in a self-fulfilling buying loop. And Wall Street's top analysts are finally beginning to realize just how undervalued this stock could be at current levels. Wall Street is heavily backing the strategic execution narrative right now. Piper Sandler recently reaffirmed its overweight rating along with a $98 price target, flat out declaring ASTS as its, quote, favorite stock in the space sector. Cantor Fitzgerald is highly bullish as well, holding an overweight rating and a $90 target. Roth MKM is leading the entire pack with a massive $108 price target, and B. Riley Securities maintains a buy rating with an $85 target. Now, with the stock currently consolidating around $72.40, these professional price targets represent an implied upside of anywhere from 18% to 50% over the next 12 months. That's a serious gap between where the stock sits today and where the smartest analysts think it's going. So the big question is, how should you actually play this? Let's break down the actionable blueprint. For long-term shareholders, the recommendation here is pretty simple. Continue to buy and accumulate shares on any technical pullbacks. The capital gap has been fully bridged, and the company has $3.7 billion in cash to execute its entire roadmap. They are marching steadily toward a $1 billion first-year commercial revenue target with positive free cash flow projected by 2029. So hold tight for the 2027 continuous global coverage ramp, which is when GAAP earnings per share is projected to finally turn positive. Now, for the short-term traders out there, look to play the ranges. Establish your long positions on pullbacks to technical support at $70.08 or the 50-day moving average at $72.39. If we see a deeper dip, look to load up near the stronger floor at $66.95 or the 21-day moving average at $65.93. And on the way up, look to take your profits near technical resistance at $75.61, scaling out fully up toward $80.52. Now, before we wrap up, a quick and important word. Everything discussed in this video is for educational and informational purposes only. It is not financial advice. I am not a licensed financial advisor, and nothing here should be taken as a recommendation to buy or sell any security. The stock market carries real risk, and you can lose money. Past performance and any price targets mentioned are never a guarantee of future results, So please, always do your own thorough research and consider speaking with a qualified financial professional before making any investment decisions. So let's bring it all together. On July 19th, the crowd panicked and ran for the exits. But those who understood the dilution shield, the surgical technical setup, and the wave of catalysts building underneath saw the exact opposite of a disaster. They saw opportunity. With $3.7 billion in liquidity, next-generation satellites now live in orbit, regulatory green lights flashing across 3 continents, and a short squeeze potentially loading in the background. The story here is only getting more interesting. Now I want to hear from you. If AST SpaceMobile hits that 200-day moving average and triggers the gamma magnet, how high do you honestly think this stock could run by the end of 2027? Drop your price target and your reasoning down in the comments below. I read every single one. And if this breakdown gave you real clarity and value, please smash that like button, hit subscribe, and ring the notification bell so you never miss the next high conviction setup. Thanks so much for watching, and I'll see you in the next one.